Megan Booter has been a member of TRP since September of 2012. And First National Bank is proud of their history. They were founded in 1857 by two brothers, Herman and Augustus Counts, if that's how you say his name. Though the founders were engaged in the rough and tumble business of the pioneers, they created an innovative and forward-looking organization. They were among the first banks to issue credit cards, long before other banks did. And they were the first U.S. company to use fuel cell technology as its primary power source. That's how they approach the future as well, and they hope you'll take the journey with them. Megan Booter.
Thank you. So today I'm going to be talking a little bit about home equity. So first things first, what is home equity? These are the kinds of definitions that you're going to get if you just look it up online. It's the value of the homeowner's interest in their home. It's the real property's current market value, less any liens that are attached to that property. This value fluctuates over time as payments are made on the mortgage and market forces play on the current value of that property. So what does that mean for us? Home equity is your home value minus any mortgages that you have on the property. So an example of that is you have a $500,000 property. You have mortgages of $300,000, so you have $200,000 left in home equity. So that is your money, basically. That $200,000 is yours. You own that home, so that equity in your home is yours. But you can't touch it, right? Because it's in your home. Wrong. We can actually access your home equity and utilize those funds for your own needs. Two ways that we can do that are through home equity loans and home equity line of credits. Home equity loans are very similar to a traditional loan. You have a fixed rate, you have your fixed term, you access it once, meaning that you start out with accessing it and you take the full value of what you want up front and you start paying interest on that value immediately. You're making principal and interest payments during your full term, and then by the end of that term, your loan is completely paid off. So very similar to a traditional 30-year fixed mortgage that you might see when you purchase your property. The other option is a home equity line of credit. These work a little bit different. I like to think of these as a big credit card. So rather than a $5,000 balance on a credit card, you can have a $200,000 balance on your home equity line. It also has significantly lower interest rates than you would on a credit card, but it works very similar to how that would work. It has a variable rate, so it can change as the market makes changes, but it has a flexible term. So you can borrow against this line and pay it back like you would a credit card. So you borrow something and then you can pay it back, and then you're back at a $0 balance. When you're at a $0 balance, you're not paying anything. You're not paying any interest, you're not doing anything like that. It just sits there and is open for your use. You also have a flexible term, meaning that you can draw from it for a certain number of years, and then once you paid it back, you can just close it down. It's not a set term. And you can have interest-only payments on a home equity line, whereas with a home equity loan, you're paying both principal and interest over the course of that term. Can make those payments very high. So interest-only payments gives you the opportunity to pay interest while you're borrowing against it and then pay it back in large sums if you choose to do so. This works really well for individuals who work on a bonus or commission basis. They pay low payments month to month, and then when they get that big bonus, they come back and they pay down that line so that they have the opportunity during those months where they don't have their commissions high or their bonuses to still manage that payment. So when can we use these? When is a better time to use a loan versus a home equity line? Home equity loans, if you're wanting a fixed payment amount, so you know I'm going to be paying X number of dollars a month for 10 years and then this loan will be paid off. That's going to be a home equity loan option. Once again, define time for repayment. You want to know by the end of this time frame I will have this loan completely paid off. That's a home equity loan. If you have one large purchase or use, so let's say you're spending $100,000 to put a down payment on a second property. You're spending that up front, you're doing it right now, and you're using all $100,000 right now. You want a home equity loan because you're going to be starting to pay that down immediately. Another great benefit of the home equity loan is it's a fixed rate. So your rate won't change with the market. It won't go up if Wall Street prime goes up. Home equity lines, on the other hand, are really beneficial if you may not use it immediately. So what if you're planning home renovations that won't start for a couple months? Or they're going to start, but you're making so many renovations that it's going to take you 2 years to complete that project. You don't want to pay interest on money that you haven't spent yet. With the home equity line, you pull what you need when you need it, and you start paying interest on that. If you have multiple planned purchases or uses for the line, so if you want to do a little bit of home improvement over here, and then you're going to do a little bit of debt consolidation possibly, you want to have a little bit available for some emergencies that you might come up, you want the home equity line, because once again, you're not using all of those funds right now. You don't want to pay interest on what you're not using. Once again, the flexible payment options comes up well with the home equity line. The interest only, so that you can make those lower payments and then higher payments when you have the ability to do so. And then finally, access to more of the equity than you plan to use. So going back to our example, we had $200,000 worth of equity. Let's say they want to do $50,000 of home renovations, for example. Do you want just the $50,000 on that line and then that's all you want to use? Or do you want to say, well, I might have an emergency come up where I need to access funds immediately. Like I need a new roof all of a sudden, and I wasn't prepared to pay $16,000 for a new roof. Home equity line of credit is great for that. Things like that come up. Or your water heater goes out and you need to replace that. So you have the ability to access up to $200,000, but you don't have to use it all. But if you need it, it's there. One thing that happens a lot with home equity loans and home equity lines is people come to us when they need them most. They're in trouble, they have a lot of expenses that are coming up, they've run up all their credit cards. At that time, we may not be able to get you that loan because of those kind of circumstances. If you get it now and you just let it sit there, then when those come up, you have it. The other thing is they don't happen overnight. So if you need the money tomorrow and you come to me today and say, I need a line and I need it today, it's not going to happen that quickly. We need a little bit of time to get it in place. So once again, having it already in place when that emergency comes up is the best scenario for you. So some common uses for these lines and loans. First of which is home improvement. We've talked about that. Benefits you because it increases that value of the property that we already talked about you have the equity in. Next piece is debt consolidation. Credit card rates are, in the high teens, low 20s, sometimes even high 20s. These loans are in the 4s, max. So really good option to consolidate that debt into a low payment option. Any big life expenses that are coming up. Are you having a baby? Are you growing your family? Do you have kids that are going to college soon? Are those expenses that you're prepared for? Or is that something that you might need a little help with? This is a good option. Purchasing a second property, very common here in Boulder. You want a down payment for your second property. Pull some equity out of your current home to make that down payment, and then you can get a primary mortgage on that. Other option for that is purchasing it all cash. So get all the equity in your current home, use that to purchase the new property in cash. As Kate says, this market is very hot, so having the cash offer is a great real estate technique to get that property that you want. Preparing for any emergencies. So this is specific to the line of credit mostly. If you have an emergency and you need funds immediately, this is the best way to get it. And retirement planning. So this is one that some people don't really think about, but it's a good thing to think about because you have all your money in investments, you have it set up so that you're making money in retirement and you're moving forward. If you have an emergency and you have to pull from your investments, you're losing out on that return. If you have a line of credit in place and you pull from that instead and then pay it back, you never lose out on the investment returns that you already have in place. So it secures that retirement plan that Dan has set up for you. So now that we know what home equity is, do we want to tap into that home equity? Thank you very much. I can take any questions. Yes?
What's the current rate and term for your fixed rate loan?
So our fixed rate loan, we offer different term options anywhere from a 3 to a 15-year. The rate is defined based on that term. I believe our 5-year is currently at a 6.49.
And the 15-year, do you know?
The 15-year I would have to double check on.
Okay. But
Yeah.
would you think it would be higher than that or lower?
It will be slightly higher because it is a longer term.
Okay,
Yeah.
all right.
Yes.
What's the difference in actually calling the loan a mortgage versus a line or a
Or a
equity?
loan. So everybody asks that question. Traditional mortgages, there's some benefits tax-wise for traditional mortgages that you don't receive anymore for home equity lines or second mortgages. A lot of people think first mortgage, is usually the primary mortgage on your property, and then a second mortgage is your home equity loan or home equity line. Now, if you don't have a first mortgage on the property, then that home equity loan or home equity line kicks up into that first position. So it still can be considered a first lien or a first mortgage on a property. It's just not a traditional mortgage in that sense.
What loan to value can you go to on your lines of credit?
So traditionally, we could go up to an 80% loan to value, but we can have certain scenarios where we can go up to a 90% loan to value. So we would look at a few different factors to determine if we can go up to that full 90, property value, loan value. We would look at the property type, that kind of thing, to determine if we can go higher than the 80.
And the pricing, you said it's based on prime?
So our home equity lines, actually, we do offer right now a promotional fixed rate option for a short period of time. We can offer a 1, 3, or a 5-year fixed rate, and then it turns variable. So our home equity lines are a good option for people that have some needs for cash now, but they're planning on paying it off in a short time because we can still get them into some kind of fixed rate term. Our 1 year right now is currently at 1.99%. Our 3 year is fixed at 4.5%. And our 5 year is fixed at 5.99. So that gets you started. You have your full 10-year term to borrow against it, but that fixes it for those first however long you choose, and then it turns into a variable rate product.
So the drop period is 10 years?
Mm-hmm.
Okay, cool.
Yep, and then there's an additional 20-year repayment period on top of that. Yes.
I would like to say that it's a very nice peace of mind to have a home equity line of credit or one of these in place long before you need it, especially now that the interest rates are low. And if, for instance, like in Mike Hamer's case, you come into a place of needing some financial help due to health reasons, you can draw off that and not really have to worry about it. So first thing you have to do is get a house. So call me.
Check the roof first.
Check the roof. And then once you have some equity in it, then we'll get your home equity line of credit.
Exactly.
Do you have to get an appraisal on your current house to get the value, or how does that determine?
We do home evaluations. Dependent on the loan size, we either do a home evaluation, or some people call it a desk appraisal or a soft appraisal. It's basically a mini appraisal. If it's a larger value loan, we do want to do a full appraisal, yes. Any other questions? All right then.
Let me offer a commendation. In situations where I've done mortgages for people and we're seeking to avoid the extra cost of private mortgage insurance, I've gone to Megan's on several occasions for a second mortgage that, along with the first, will comprise 90% of the purchase price of the property. So the first would be 80, the second would be another 10%, and by so doing, they're able to either avoid private mortgage insurance, or in another case, avoid the loan becoming a jumbo loan, because the first mortgage we want to keep below whatever that conforming loan limit is.
And it also decreases the amount that they have to bring to closing during the purchase of that.
Yeah,
loan.
yeah.
Yep. All right. Well, thank you.
Thanks, Megan.